In the name of God, the most merciful, the most beneficent. And in this part of this lecture, we will be covering cost of capital under long-term financial management under corporate finance. This is CMA part. So the learning outcome for this part: define the cost of capital and demonstrate an understanding of its application in capital structure decisions, and determine the weighted average cost of capital and the cost of its individual component. Cost of capital formula is given by the weighted average cost of capital, and we have cost of equity, on which we put the weightage of the market value of equity divided by the total value of financing. And similarly, the cost of debt we find and we apply the weightage market value of debt divided by the total value of financing. And only when we calculate the cost of debt, we apply also the income tax rate benefits, because the interest income payable, interest expenses from the company's point of view payable is deductible from the income tax point of view. So that's why we pay 1 minus the tax rate applied. So for example, if it was a 30% income tax rate, then we calculate the cost of debt, and that actual cost of debt will be only 70% of that cost of debt that we arrive at will be the actual cost of debt, because of the 30% is income tax deductible. So that's how we have to calculate that way. So the weighted average cost of capital formula includes the weighted average cost of equity plus the weighted average cost of debt. So when we calculate the weighted average cost of equity, it is also include the cost of common stock as well as the preferred stock. So accordingly, we will see in detail. So that is how, and this is the formula explained with the values here. So this diagram, thanks to Corporate Finance Institute, put up a very explanatory diagram. So weighted average cost of capital, that shows the cost of equity and cost of debt, and cost of equity can be calculated like equity risk premium whatever into that beta value, that we multiply the beta value so that we get the equity risk premium, plus we get the risk-free rate of return, which we have already studied also. So that then we get the cost of equity, and with that we want to put the weightage, the total financing, how much is the portion of equity capital. So for example, if 50% debt, 50% equity, that means 50 by 100. Here you have to multiply that in order to get weighted average cost of capital. And here, if the cost of debt is whatever, if it is a 50% of the debt financing is there in the total financing, so 50 by 100. So it will be the weightage applied on this cost of debt, so that both added together, so we get weighted average cost of capital. And for the cost of debt, we know that average yield of the debt into the tax sheet, so 1 minus whatever the tax percentage. So we apply that, then only we get the cost of debt after tax. The cost of capital is a cost that a company must pay in order to acquire capital. It is a composite of the cost of various sources of funds comprising of firm's capital structure. It represents the minimum rate of return that must be earned on new investment so that shareholders' interest won't be diluted. So what is that cost? What is the expected minimum rate of return that will not dilute the shareholders' interest, existing shareholders' interest? So up to that much is the can be taken as the return, expected return of rate of return. So we will see that how it is practically. Cost of capital typically encompasses the cost of both equity and debt, and within equity we have common stock as well as preferred stock. So weighted according to how we do the weighting, weighted according to the company's preferred or existing capital structure, known as the weighted average cost of capital. Normally we have the company's total capital structure will be threefold, like common stock plus preferred stock plus the debt financing. So maybe 50% of the common stock, 20% debt financing, 30% preferred stock, whatever it is. So this is called 50 by 100, 20 by 100 and 30 by 100. So these are the weightage for each thing. So accordingly, we can calculate the weighted average cost of capital. The cost of capital U is used for two main purposes. The main objective of this, why do we calculate the cost of capital? One is a comparison of alternative sources of funds may be made to select one which has least cost and maximum contribution to wealth maximization. For the business, which cost is cheaper, so that is important, and also without compromising on the control need also. Like that is the thing that management has to look at. And another objective is to evaluate investment proposals as it provides a benchmark to yield a minimum return. So this is used as a benchmark. So if there is investment proposals come, so we see what is the cost of capital on that. So accordingly we can evaluate. A company's investment decisions for new projects should always generate a return that exceeds the firm's cost of the capital. So any new idea, new investment plan comes. So what is the existing cost of capital, and that should exceed, the return should exceed that cost of capital. Then only that investment can be considered as worth. So this is how this cost of capital finding is useful. Weighted average cost of capital. The weighted average cost of capital is the most common way of expressing the cost of capital for a company. In order to calculate the weighted average cost of capital, we must first calculate the cost of each component for the debt, cost of debt and cost of preferred stock and cost of common equity of the firm's capital structure, and then determine the appropriate weighting. What is the weightage? And the weightage can be on three methods that we can take it. One is based on the book value weight, which is more common, that we take proportionate value, proportion of each type of capital to the total capital percentage based on book value. So the total capital will be treated as 100%, so that how much is the debt, how much is the preferred stock, and how much is the common stock. So like that we have to calculate. And another option is that market value weightage. Instead of book value, we take the current proportion based on the market value, and we take that also as a percentage, as a total capital value. If it is 100, how much is the each segment? And target value weights, that is similar to market, but it is not at the actual market, but this is the optimal, what should be the optimal capital structure. It is actually from the, we take from the book value, we calculate from the market possibility, what should be, then accordingly we think about strategic decision. The management decide that what should be our common stock holding and what should be our preferred stock holding and what should be the debt financing. After all calculations, then we will have a target in the next few years, how we are going to arrive at. So we take that target proportion, accordingly we calculate the cost of weighted average cost of capital. So this is how the formula. So we arrive at that in the earlier diagram. We arrive at that cost of equity and cost of debt after tax. With that, we multiply the weight, whatever weightage that we arrive at, we apply that weightage, and then here also we apply the weightage. Then we take the both two, and in order to get weighted average cost of capital. Actually, there are three aspects, but what we are including here is the cost of equity, is also the cost of common share as well as the preferred share. But when we are into detail, part of the examination point of view or in the company structure, to the existing situation, we will see how the calculation in detail also in the coming presentation. So this is what individual capital components, actually we need to calculate that. So we determine the individual components in a firm's capital structure, whether it is a debt, preferred stock or common stock. Use appropriate method of financing. For each financing, how are we doing that? Debt financing, preferred stock and common equity. And these are the formulas that for cost of debt, for example, how do we calculate the cost of debt? So cost of debt, required rate of return that providers of debt capital, example loans and bonds require. The basic formula is after tax cost of debt is, so first we get the investors on the debt financing, what is their required, so how much they are expecting, so that also for giving loans and all this thing. Okay, the provider, whoever is providing, the investors or the lenders, so what is their expectation, and then there is a tax benefit calculation, so whatever that rate you get that, so with that you multiply by 1 minus the tax percentage, so that supposing if it is 30% tax, so 1 minus 30 it means 70% it comes, I mean 0.70, 0.7 it comes. So that if you multiply that, the actual after tax cost of debt will be arrived. So this K stands for the before tax cost of debt, and T stand for the marginal tax rate. So then we calculate accordingly the after tax cost of debt. So what are the consideration and interpretations? So different types of debt require different interest rates and income tax effects on interest rate. Supposing in your company, if you have various type of bonds issued, different type of debt instruments, so maybe each thing will be having a different rate of interest, and so you have to calculate individually according to this way to calculate. Okay, not with a common rate. The higher the tax rate, the lower after tax cost of debt. So we know that it is. For example, if the tax rate 30%, the multiplying factor becomes 0.7. But if the tax rate is 40%, the multiplying factor is 0.6. That will it will be taken into consideration. So accordingly, you can do that. Okay. The higher the tax rate, the lower after tax cost of debt. So cost of debt example. ABC company's debt consists of 6% interest bearing bonds which are selling at par. The anticipated tax rate is 35%. So the cost of debt can be calculated like 6% multiplied by 1 minus 0.35, which become 0.65. 0.65. So when you multiply that, it will become 3.9%. This is what the way that we calculate cost of debt. After tax cost of debt, some more examples. XYZ company has sold $50 million of $1,000 par value, 12% coupon bonds. Okay. Unless it is specifically mentioned, earlier we discussed that coupon bond, normally in US companies, they issue coupon even for semi-annual, like 6 months. But unless if the question is not mentioning that, you have to treat it as annually it is paid. So that you have to remember, even from the examination point of view. Okay, the bonds were sold at a discount, and the corporation received $985 per bond. Okay, so that is that. If the corporate tax rate is 40%, the after tax cost of these bonds for the first year rounded to the nearest 100% is, so the calculation. So the effective interest charge is 1000, the 12% coupon bond, which is 12%, minus tax rate is 40%, so it comes to $72. So you calculate this, it means 12% means 120. So 12% means it is 120. So 120 multiplied by minus that 40% is minus. So the remaining is 72. Okay. So the 40% represents the tax savings. Since these bonds were sold for 985, because this is the bonds selling rate. So in order to calculate the cost of the bond, you have to calculate the cost of the bond 72 divided by $985 in order to get the rate of cost of at a percentage value. Because this $72 is actually earned for the $985 that company receives, because the company is par value is 1000. Okay, par value is uh, 1000, but actually selling at the discounted rate, which is $985. So actually the company is receiving funds at the rate of $985 per bond. So that is why that is the actual capital that they receive. So therefore that is the amount. 72 is their cost that payable. So accordingly they get 7.31%. So we calculate that. Cost of newly issued preferred stock. So the cost of new preferred stock is calculated in much the same way as the cost of debt, because it is also almost like fixed cost. Fixed cost for the investor, it is like a fixed income and all. So it is the kind of similarities are there. So accordingly, it is also like similar to the cost of debt calculation. So because most preferred shares pay the dividend in the form of some percentage of the face value of the shares. So like interest only. Okay, though they are not tax deductible. That is the only primary difference between them. So you cannot have a tax deduction attribute here. Okay. When issuing new shares, however, the firm will incur float, but that is also there. When issuing even bonds also, there is a flotation cost. In the examination, if there is a question comes, that cost also you will have to adjust it. When issuing new shares, however, the firm will incur flotation costs, including administrative expenses associated with registration of the security and investment banking fees paid to brokers who sell the security. So this is flotation cost. That cost will be given from the examination point of view as in terms of dollar per share, something like that. Or maybe the total amount for the total number of shares, you get that dollar per share. How much? Like that. Okay. So the flotation cost reduce the proceeds from the sale of the security. This is one important point you have to note down. Supposing you get the after the flotation, you get $1,000, but the flotation cost is the expense that you have already paid. So you have to deduct it that you get actual receipt. So that is the idea that you have to get it. So let's see an example. Cost of newly issued preferred stock. So we are discussing about the flotation cost that reduce the proceeds from the sale of the securities. For example, if the preferred stock sells for $25 per share and we have flotation cost that incur $2 per share, the net proceeds of the issue will be $23 per share. It's a simple calculation. The formula for the cost of the issuance, therefore, to be calculated is we have to take the T, which is the yearly dividend, and the net proceeds P, the net proceeds of the issue, which is in this example $23. So that is how we have to calculate that. Let's see with some examples. ACME Corporation is selling $25 million of cumulative non-participating preferred stock. The issue will have a par value of $65 each share. Okay, $65 per share with a dividend rate of 6% is the dividend rate. The issue will be sold to investors for 68 per share. So it will be sold at premium, which is 68 per share. And issuance cost will be $4 per share. So there will be cost $4 share. So solution, if we calculate that, the company will receive only $64 per share. How? Because they are selling at 68 per share, but they incur $4 per share. So therefore they receive only 64, which is the net amount. Okay. So that is the company will receive only 64 per share. But the dividend that they will pay is 6% on the face value, par value, which is 65. So accordingly, if you calculate 6% on 65, it will be $3.90. So actual the cost of the preferred stock will be the $3.90 will be the actual payment based on that 6% on $65 divided by actual money they receive is $64 only. So divide by that. So cost is 6.09%. See the difference. Even though the dividend rate is 6%, the actual cost of that dividend is 6.09%. Why it is so? Because the issuance cost is $4 per share. Though they are selling at premium than 65 at premium, which is only $3 more, but net there is $1 loss to the par value. So that is also you have to see that. Cost of common equity. There are two main ways a firm can raise common equity capital. One is to calculate the retained earnings, because retained earnings are not coming from external sources. They are coming from internal funds. So that calculation is not like market rate and all these things. It is only internal sources, that is a separate one, and it is like a sunk fund, but still opportunity cost has to be thought out for the usage of retained earnings. What if I use that fund instead of using in the company, in depositing outside or some other investment? So that is the opportunity cost that we have studied already. If not, we will see in detail in the next lectures also. So another part is the new common equity, new issues of the shares. So if we take the retained earnings, profits are mostly retained and not distributed for reinvesting into the business. The firm incurs no expense for using it, but we can take into consideration of the opportunity cost of using the funds for alternative use. So the cost of retained earnings is based upon the risk of the firm and investors' required rate of return. And there are different ways of calculating the cost of retained earnings. One is the dividend golden growth model and capital asset pricing model we have seen in the earlier lecture also, and arbitrage pricing theory. So we understand that there are various methods that we have to use it, and we will test one by one. New common equity calculation. The new shares of common stock can be issued, and it incurs flotation cost also, that we should remember from the previous examples we have just learned. So whenever we are issuing new shares, then there will be flotation cost, including commissions and other bankers charges, security fees and other things. And for new common equity calculation, the dividend growth model will be used. So cost of retained earnings based on the dividend golden growth model, it can be called. So maybe if there is a multiple choice question come, you will see what is golden model. So that is dividend growth model. Okay. It is also called the dividend discount model and uses the dividends per share, the expected growth rate of the dividends, and the market price of the share in order to estimate the cost of retained earnings. For the company to support a decision not to distribute its profit, it must be able to generate a greater return than the amount calculated by the dividend plus a growth rate in the level of dividends paid. So that is the calculation, that whether economically if this is sound decision to use that fund in this way, or if there is another opportunity to go for that. So the formula for calculation is the cost of retained earnings equal. So first, the next dividend, the D1 stands for the next dividend that is to be paid. That means last year dividend multiplied by the growth rate by 1 plus the annual expected growth rate. So supposing if the growth rate is 5%, so you put 1.05, you multiply the current last year dividend, multiply that by 1.05, so that you get the next dividend possibilities, because you get the growth rate. So that is what explained here. Until the common stock price, the base price P0, that is the base price. So we get that. What is that base price today from the market that you get it? So you take that division, with that you add the annual expected growth of dividends. So here what is important point is that you take the first, the last dividend paid, and in order to see what is the next dividend, you have to adjust it with the growth rate. That is 110. First you have to do the adjustment. That is whatever the last dividend multiplied by 1.0, that percentage, actually 5, 6, whatever it is. So that you get that figure. And then the price of that divide by that. So you get that value. That is the percentage. That percentage you add to the growth rate percentage. So that is the cost of the retained earnings. So this is the formula that you have to. So an example, the company expects the next dividend to be 6. while the market price of the common stock is $40. Market price, the P0 is given, and the dividend, next dividend is already given in the example question, so you don't need to adjust it for the D1 value here. The D1 value is already given here because the next dividend means this is the D1 value, so it's already given here. But the growth rate is also given. The growth rate is 9%. So simply you calculate that 6 by 40 plus that 0.09 growth rate, so you get 0.24, 24%. An important assumption in the dividend growth model is that the dividend will increase by the same percentage each year. That is what the growth rate calculation. It may not be in the realistic value, but if you are using the dividend golden growth model, so it is the assumption that it is a constant rate. So that is important point. So for cost of new common equity, the flotation cost need to be factored into the calculation. So it has to be included. And individuals who purchase shares equity assume a greater risk than debt holders, and hence it is more expensive for a company to raise money through the issuance of shares than through debt. So that is that. With this understanding, let's see the calculation formula. So the formula that we will use to determine the cost of newly issued common stock is the cost of new issues equal the next dividend divided by the selling price minus the issuance cost. So whatever that we have, the net proceeds of the issue, whatever the flotation cost, you have to say what is the money we will get per share, if it is premium, was whatever the amount minus the flotation cost. So that is the net proceeds of this. So you take that, then you get a percentage or a ratio. With that you add the growth rate. So simply we get that cost of the new issuance of common stock. So this is our simple calculation. So this is the same formula as used to calculate the cost of retained earnings, except the firm incurs flotation cost. So here we are adjusting with the flotation cost. So that is the idea of that. One CMA adapted question. So a company in Numas Inc. paid a cash dividend to its common shareholders over the past 12 months, that is $2.20 per share. The current market value of the common stock is $40 per share, and investors are anticipating the common dividend to grow at a rate of 6%, which means a growth rate annually. The cost to issue new common stock will be 5%, that is a floating cost. We can understand that. So the cost of new common stock, therefore we can calculate is this. So we are seeing the cost of the D1 value. First we have to take the D1 value is given by that the dividend, which is $2.20. So we take that, and that we have to add with the growth rate also, because the past 12 months dividend is 2.20, but now we have to take the next dividend. So next dividend has to be adjusted with the growth rate, which is given by 6%. So accordingly 2.20 multiplied by that growth rate. So it is nothing but you just say 2.20 multiplied by 1.06, you get this value. Or you calculate the $2.20 plus 2.20 of 6%. So you both add together $2.332, which is the D1 value as per the formula. Then the P value, which is the principal amount that is common stock, is 40 per share. So out of this 40, from these you calculate the floating cost, the cost of that is the 5% of this floating cost, which is 5%. So you calculate that 5%, you deduct it like 1 minus 0.5. So that is nothing but 95% of the 40. That is the thing. So okay, so that is $38. So what is 5% of that is, for 40 is 2. So accordingly 40 minus 2 is $38. So if you apply that, you get 12.14% is the cost of new stock. So 12.14%. In this exercise, first we calculate the next dividend value using the growth rate. So we are taking the 2.20, calculate the next dividend, which become 2.332, and then divide by the adjusted principal amount that we get, and so we calculate that. Another CMA adapted question. So using the capital asset pricing model, what we need to find is the required rate of return for a firm, and the given values are like beta value 1.25 with the market return is 14% and the risk-free rate is 6%. So actually the solution is, the required rate of return is that risk-free return plus adjusted beta adjusted market rate of return or minus risk-free return. So what we need to take is, first take the market return minus the risk-free return, and that has to be adjusted by the beta value, and whatever the value comes with that, we have to add the risk-free return. You get the required rate of return. Taking that examples, so here we take the risk-free return 6%, and then beta adjusted the 14% of the market return minus that risk-free return, so we get 8%. So of that we get that will become 8, 1.25 become 10, so 10 plus 6 is 16%. So that is how we calculate that. Beta measures a security volatility or systematic risk, so that is why the beta adjustment need to be done in order to adjust for the systematic risk relative to the movements in the overall market. So this is the market condition, okay, and it is the volatility in the market. Another CMA adapted question: a firm is planning to use retained earnings to finance anticipated capital expenditures. The beta coefficient for the firm's stock is 1.15. The risk-free rate of interest is 8.5%, and the market return is estimated at 12.4%. So if a new issue of common stock were used in this model, the flotation cost would be 7%. So everything is given like market rate, growth rate, and beta value, and the flotation cost. So by using the capital asset pricing model, same formula just we see last, the cost of using retained earnings to finance the capital expenditure is, so we have to find out what is the cost of retained earnings using the CAPM, capital asset pricing model, given with the values. So the formula is given risk-free rate of return plus, so beta adjusted the market return minus the risk-free return value. So you take that. So first 8.5%, which is the risk-free return. So the risk-free interest rate is 8.5% plus beta value 1.5 multiplied by that, it is 12.4% is the market rate minus that, it is risk-free return is 8.5 adjusted. So you get accordingly the value 12.99%. Okay. So here floating cost need not be considered for the use of retained earnings. This is an important point. So why we are not taking the flotation cost of 7%? This is the tricky part in this question, because in the exam question it is given retained earnings is the decision. It is the subject matter in the decision. And for retained earnings, there is no need of flotation cost. That's the understanding that we should have, because only for the new issues there will be flotation cost. Retained earnings means that is as good that we take the money from our cash box, from our own pocket. So that is the idea. So that is the tricky part in this question. Everything normal, but only this they are giving that we should ignore that. Okay. Datacom Industries has no current debt and has a beta of 0.95 for its common stock. Management is considering a change in the capital structure to 30% debt and 70% equity. Whatever earlier, but now they want to change to 30% debt to 70% equity. Total, if you add, it becomes 100. So this change would increase the beta on the stock to 1.05. Instead of 0.95, it will become better to 1.05. And the after-tax cost of debt will be 7.5%. So after tax cost of debt will be 7.5%. So the expected return on equity, they mean market rate of return is 16%. So that is also given. And the risk-free rate is also given 6%. Should data accounts management proceed with the capital structure change or not? Should they change to that or they leave it like that? So the answer is there are four options. One means no, because the cost of equity capital will increase. B, yes, because the weighted average cost of capital will decrease. And C, no, because the weighted average cost of capital will increase. D, yes, because there will be no effect on the weighted average cost of capital. Let's analyze this question. So, first option A is not correct because the cost of equity capital will not increase. Okay, and how we will calculate that, we will understand that. Okay, using the capital asset pricing formula, we can determine that the current cost of capital consisting only of equity of the firm is 15.5%, that is coming from the actually interest free rate is 6% plus the beta adjusted, that 0.95 multiplied by 16% minus that risk free rate, so you get 15.5%. So that is the value. Actually, so the equity, the rate is 15.5%. If we do this way, this with a new thing, but if we adjust it to the beta on stock, once we adjust it to 30% debt and 70% equity structure, once we do, what is the change? The change is that beta value will be changing. So same formula, so we again calculate with the beta value only changing. So that's the thing. Simply we do that, we get 13.8% of that change. So same rule apply, but beta value is 1.05, we take that. But only thing, because the debt financing is come and the after tax cost of debt is used here. Okay, so that cost, after cost of debt will be used here. So we take that, and 30% will be for the debt financing. So only 30% of that 7.5 cost plus 70% of the equity, which is 0.7 of this cost, the equity cost percentage. So in total you get 13.18%, which is less than this value. So that's why, yes, because the weighted average cost of capital will be decreasing, therefore it is preferable. The cost of capital is decreasing, so it is preferable for the company. So this structural change will add value for that. And no is not the answer. Yes, because there will be no effect on the weighted average capital, which is not true. It is saying yes, but no effect on weighted average capital is not true, because the beta value is changing and also the capital structure is changing. So two changes are there. So that is the idea. So the company should proceed with the capital change, as it will reduce the weighted average cost of capital. The marginal cost of capital. Marginal, it is a weighted average of the investors' required return on debt and equity. What does that mean is, when we add one more dollar, so that is how the calculation has to be checked. So when we calculated the weighted average cost of capital, we always used marginal cost actually, or the cost to acquire new dollars of capital. When we add one more dollar, what will be the cost? What will be the change in the cost? So that is the, what will be the additional cost? So that is the marginal cost of capital. So the next dollar of capital from bonds. It is weighted average of the investors' required return on debt and equity. So given by this flow, flow diagram. The concept of marginal weighted average cost of capital, or we call it as MCC, is very important for optimizing the capital structure. So when we calculate only, then we can go whether we can increase this way with this cost or not. If we do the changes in structure for all these things, the marginal cost of capital analysis has to be done. The MCC is always increasing because it will be keep on increasing because the cost will be increasing for adding one more dollar. Okay, the investor will demand a higher return because that is the thing important. The investor will demand higher return from the investment because the company would have more financing outstanding, carrying more risk to the supplier of the next financing resources. It is sorry. It is a simple strategy. If you want more fund from your finance supplier, so they will be, they will say that yes, okay, I can supply, but the rate will be changing and it will be improving because for him the demand is low. So that is the idea. That's how the external market, the investors will work that way. Okay, let's see one CMA adapted question. The firm's marginal cost of capital should be the same as the firm's rate of return on equity or is unaffected by the firm's capital structure or is inversely related to the firm's required rate of return used in capital budgeting. Option D is a weighted average of the investor's required return on debt and equity. Yes, because we have just seen in the graph also, it is a weighted average of the investor's required returns on debt and equity. So that's we have to calculate the weighted average of the investor. By calculating the weighted average of the investor's required returns, we only calculate based on the marginal cost of capital. Another CMA adapted question. So says XYZ common stock is currently selling for $100 per share. The firm expects to pay cash dividends $7 per share next year, and the dividends are expected to remain constant. The stock will have to be underpriced by $3 per share, and flotation costs are expected to be $5 per share. So, what is the cost of funds from the sale of common stock? So, the cost of funds is given by the formula R equal to the dividend one, that is the dividend expected next year, and the price multiplied by 1 minus the flotation cost. So means after deducting the flotation cost, what will be the amount, the price. Okay, so that is the idea. So when you add together and then expected growth rates, so you can add that to the rate of return. Now given D1 value is $7, so D1 value, and PO is $100 and underpriced by 3, so it is given here, so it will be $97. So the P value will be $97, and with that you have to multiply the flotation cost, which is $5. So flotation cost is equal to $5, and the growth is, because it says it is remain constant, growth rate is 0. So you take the 97 multiplied by 1 minus 0.05, which is the flotation cost. So after adjusting that, 7 divided by this amount, and growth rate is 0, so it becomes 7.6%. Another question. XYZ common stock, same detail, 100 per share, and the firm expects to pay cash dividend $7 per share next year, and the dividends are expected to remain constant. Okay, the stock will have to be underpriced by $3 per share, and flotation costs are expected to be $5 per share. And in the same story, it continues that XYZ expects to have available $100,000 of retained earnings in the coming year. Once these retained earnings are exhausted, the firm will use new common stock as the form of common stock equity financing. Now you have to find out the cost of retained earnings of XYZ. So it is given by the formula that the rate of return is equal to the D1, the expected dividend, so that you can take the expected dividend payable for the common stock So which you will have to take because it is under the within the group of common stock. So you normally take the dividends to the common stock D7. So you take the dividends as $7, and it is you can assume that for that $7 and the dividend, so you can break it into $100 the retained earnings also. So you take that the P0 value also as $100. So you take that and it becomes 7%. Question: by using the dividend growth model, estimate the cost of equity capital for a firm with a stock price of $30 and estimated dividend at the end of the first year is $3 per share and an expected growth rate is 10%. So it's easy here given by the solution, the dividend next year and divided by the price and plus the growth rate. That's it. So if we plug the numbers into this expression that we get, because it's the end of the estimated dividend at the end of the first year is $3. So $3 and the price is $30 plus because the expected growth rate is 10%. So from here it comes to 10% and plus 10% becomes 20%. So this is the cost of equity capital under dividend growth model. And another question: ABC company is preparing to evaluate the capital expenditure proposals for the coming year. Because the firm employs discounted cash flow methods of analysis, the cost of capital for the firm must be estimated. The following are information for ABC company. So many informations have been given. Market price of common stock is $50 per share. The dividend next year is expected to be $2.5 per share. Expected growth in dividends is a constant 10%. And new bonds can be issued at face value with a 13% coupon rate. The current capital structure of 40% long-term debt and 60% equity is considered to be optimal. Anticipated earnings to be retained in the coming year are $3 million. The firm has a 40% marginal tax rate. If the firm must assume a 10% flotation cost on new stock issuance, what is the cost of new common stock? So this is the question. So although this question has a lot of details, maybe this is part of the essay type of questions where there will be different questions also there. But students should be aware that whatever relevant data you have to pick it from this and calculate accordingly. So according to the dividend growth model, the price of stock is D1, that is the dividend next year is expected, and the price. So the price can be calculated from here. See, 50 per share, common stock price is 50 per share. From there you have to see also the flotation cost. So you have to deduct that. So if you deduct that, the 10% of the share is $5. So 50 minus 5 is $45. So the price, the market price after the flotation cost is $45. So if you plug that numbers into this, so which is given 2.5 per share divided by that 45 plus that growth rate, which is the growth rate 10%, you get 15.56%, which is according to the dividend growth model, the price of the stock is at 15.56%. Price B2 call, and then we will continue in the next lecture which talks about the derivatives.